Hey, it's getting warm, so I thought it's time to start doing some more videos. My morning walk is doable again, finally. It's been a long winter, folks. So today we're going to talk about the liquidity tidal wave, as I've heard it called, and what it means to the field of investing. So, to understand what this means, we have to first kind of look at how the stock market works. And this is pretty important because in my 20 years of working on impact investing, one of the biggest issues, sorry, there we go. One of the biggest issues is liquidity. And what does liquidity really mean? Well, the Securities Act of 1933 basically ended liquidity because it ended free speech and the free buying and selling of securities. So what that did is it pushed liquidity only into the public markets, and then we had kind of a liquidity gulf or black hole. And so it's kind of like this. It's like if we look at Wall Street like a big department store. Well, if you're getting products into a department store, you're going to have the raw materials, and then there's going to be a manufacturer that assembles those into goods, and then those goods get distributed. Perhaps there's like a distribution point, and then that's going to be called wholesale, and then you've got the the NASDAQ, the New York Stock Exchange. Those are the majority exchanges of the world. Like a lot of countries have stock markets, but anyway, that's the retail stock market, and they call it that. I mean, they call it retail investors. So with the Securities Act of 1933 prohibiting direct sale of securities to individuals, what developed was the middleman and the venture capital firms. And the venture capital firm structure was almost a necessity after the Securities Act, because it became almost impossible to raise money for small businesses that were scalable. And the venture capital firms organized wealthy people without access to the general public, with that free speech prohibited. Then it became, again, nearly impossible for companies to find a sufficient number of investors, wealthy or not. And why is that? Because I've raised millions of dollars, most of it in the charity world still. And what I learned from that is that when, in the charity world, you can speak to the general public. And what I learned from that experience is that wealthy people are people. Hard to believe. But yeah, they're really people with real concerns. They just happen to be, some people are good at one thing and some people are good at other things. So anyway, when you market to everybody, inside of everybody are wealthy people. At the nonprofit that I built in Washington with our, team, co-directors, our typical donation like, I wrote a thank you note to anybody that gave us $100. I mean, we were pretty hard scrambled, but every once in a while we'd get a call from a very wealthy person and they just say, hey, we have a lot of money, do you need any? And I'd say, sure, yeah. So that was a lot better than chasing after them. But again, after 1933, that kind of dynamic was pretty much canceled. And so that meant that entrepreneurs who wanted to raise capital had to focus all their energy on just finding wealthy people. And it's kind of like anything. When you chase somebody, they run. If you're attractive, they'll come to you. So as a result, entrepreneurship became pushed up much more into the realm of the already wealthy, who happen to already know wealthy people, and so that gap that wasn't as great. And if you look at a lot of the literature about raising capital, I remember reading one thing. He said, well, I'm a member of a golf club, and if I talk to my friends there, is that a public offer? Because public offers, unregistered public offers became illegal after 1933. So what's the point of this little story? The point is that the presumption is that if you're raising capital, you're already a member of an elite golf club. And now it's just a matter of following the rules. Well, that means somebody from an underserved neighborhood, somebody who doesn't have a bunch of wealthy friends, can't find them. So that's been capitalism in the U.S. and most of the West for the past nearly 90 years now. And because of that, people have really lost a feel for what capitalism really is, and so it gets ascribed to so many different, whether you love it or hate it. It's just an approach to organizing money. And there's a handful of approaches in the world. I read somewhere, for example, that Sweden, which has large socialist components in their economy, also has the most billionaires per capita. So pretty much every country in the world has a spectrum of kind of a government sector control, and then controlled by we'll call it the merchant class. And it's really the ratio, how much is shared. Like if you were to look at the notion of pure communist, there would be no private individual ownership of assets. And in a purely capitalist country, there would be no government, because there would be no collaborative ownership of assets. So, I don't want to get too deep into politics, but there's a stock market in Russia. Russia's held up as a communist country. They've got a stock market. And the U.S. has various socialized services like the fire departments and the police departments and roads and the national parks and the national forests. These are all socialized, government ownership of assets. And then the debate, you've got people in the world that are arguing that the national park should be, if people care about national parks, then the capitalists should buy it. And, and then you've got people on the other side, they're saying, well, there should, again, everything should be done through government and through some kind of process. And I think I'm just a pragmatist. And I spent 14 years in Washington, D.C., 10 of them working 3 blocks from the U.S. Capitol building. And not all governments are as crazy as the U.S. government, but still, there's a characteristic to that. So anyway, let me get back on track. So the government, again, in the 30s, impinged on the free speech of people who wanted to raise capital. That's resulted in, I believe, a very lopsided wealth distribution in the U.S. in particular, but other countries around the world followed suit. And now, though, the trend is starting to reverse. So what happens if the only liquidity is at the level of the NASDAQ or the New York Stock Exchange? If that's all the liquidity, then that means that there's sort of pent-up demand. You've got this huge public that wants to own stock in companies, and all the energy is focused on the retail sector. So that pushes up what people call alpha. And alpha is really the markup, the profit margin between the wholesale production of investment products and the retail. So with the rise of fintech, financial technology, online transactions, so the movement of money, originally even that online was still pretty much the kind of the sole domain of large banks and large exchanges. But it's kind of like this. And, you know, I did my first online transaction in the 90s. It was so hard to get together the pieces that would allow somebody to make a payment online. And if you think of Amazon.com, they spent, I think that, you know, they invested like hundreds of millions of dollars to perfect the transaction. Now, pretty much anybody with WordPress and a Stripe account can set up a transaction for free. And you just have the cost of your WordPress server. If you want, you get a WordPress server for, I don't know, $4 a month. And suddenly, you snap together a few components and you've got e-commerce. Well, the same thing's happening in the financial sector. That it's a little more, it's a lot more regulated. I mean, in the end, there's a lot of regulation around the enterprises that hold the money. So for example, in the earlier example I said, you've got a WordPress site and you put your shopping cart, usually something like WooCommerce, and then you plug in Stripe. So Stripe runs a very highly secured website. And so when somebody makes a payment on your WordPress website and it goes through the shopping cart, and then shopping cart talks to Stripe, and nobody on, like, your site and your server have no access to the customer's transaction data, like their credit card number. The secure data, which is the money data, that travels through exceptionally secure servers and highly regulated processes, because obviously without that, that's a lovely opportunity for fraud. So same now with the rise of, say, crowdfunding sites, investment crowdfunding sites. Now there's a lot of movement of much larger amounts of money. It can be tens of thousands, hundreds of thousands of dollars at a time. People are transacting into equities and securities, and so those kind of transactions, developing the trust and the security and the integrity now that's coming more and more down market. So again, if we say, well, Amazon spent 100 million or 200 million figuring out how to do the online transaction, and now that's free, the same trend is happening in securities transactions, which are just a much more regulated transaction than normal retail transactions. So you have the fintech revolution, and then combining that with a reopening, gradual steps toward free speech and free flow of capital into securities. And anyone that's raising capital, even if they're a little tiny startup, that's a securities offer. So again, highly regulated transaction, a whole ecosystem of fintech companies. And the result is we're getting this, people are saying, well, there's all kinds of assets now that we would like to create liquidity. So for example, I heard this, I haven't looked myself, but just a shout out to this guy Gali on a YouTube channel called Hyperchange. The guy really brings some great information, and he's talking about liquidity in baseball cards, because there's some baseball cards that people think are worth $100,000. Like, it's not worth $100,000 to me personally, but it's not even worth zero because I don't want any more I don't want any baseball cards. But for some people, certain cards are going to be worth large amounts of money, and they're willing to. They see that value, and then now there are investment crowdfunding sites where you can bring liquidity to that. Now, I personally am interested in vegan founders and vegan businesses, so that's the asset that I'm interested in, liquidity, and that's why Vegan Launch is the first vegan investment crowdfunding site in the world where the general public can participate in our equity offers. And we've had our first offer up that went up late last month, and now we're marketing it. Now, before 2016, what I'm doing would have been illegal, but now it's not. And so that means we can bring more capital, but the real liquidity is the exit. So again, if we look at investment products like any other product, for the last 90 years, there's been, the venture capital firms have been, you might say, the wholesalers, and then they do work on the investment product, and then if they're successful, they sell it at a really big premium at an IPO or via a merger. So you can see the merger and the IPO, those are just two liquidity points where the original investors could get any cash. Well, now there's the rise of secondary markets, and so secondary markets provide liquidity much earlier down the line. So what does that really mean? That means that there's always going to be a premium for liquidity of some sort, but if that, Wall Street is, the retail stock markets control all the liquidity, that means that we're paying huge premiums for assets that are traded on the NASDAQ or the New York Stock Exchange or other global exchanges. When we bring liquidity downstream, or maybe upstream, I think is the right place, when we're bringing liquidity earlier in the development process of securities, that means that the ability to be involved in the construction and design of investment products is also moving, like it's becoming more democratized, we could say, or it's such a funny word, but maybe more populist. More and more people, let's just say that, let's just use plain English, more and more people now can get involved at the transaction point or the transaction style of venture capital firms, which again is buy a product more or less from the manufacturer, package it up, maybe put some improvements on it, and then flip it out to Wall Street. So this is good because the more liquidity there is and the more people that participate, the more companies we can start, and more quickly, that more rapidly track values. So there's been a lot of discussion lately. I think you all know Oatly had a $200 million private round, and the story, the founder's story, just begging the Blackstone group to take them on because they really didn't have that much access to anybody that could do the transaction that they needed, $200 million transaction. Well, now Vegan Launch can do a $75 million transaction, a little less than half, a Blackstone group on our website. We just, of course, have to market to the people, and we can go direct to retail. So what would that do for the next Oatly? That means that not only can they get earlier stage investing from a broader, it's not a restricted market. That means they're going to get better valuations. And yet, because of the liquidity moving, broadening into our society, that reduces a lot of the risks. Like one of the major risks of early stage investing is lack of a liquidity event ever. It's possible that companies can never get sold, but now that risk is getting diminished because the combination, again, of fintech and legal reforms, more people can participate in the market. So that's good. That balances out a lot. When people talk about Wall Street, a lot of the problems come because the liquidity has just been concentrated in the hands of a very few people. And that's let's say from the point of view of an ecosystem, that's not a stable approach to an ecosystem. You want to have vitality at every level. So what does this mean? Again, I'm going to give another analogy. I used to live in Utah, and that's a big mountain biking state. And but the price of a really good mountain bike then was maybe in the neighborhood of $10,000. And then there was a company there. Now, if you think of the path of a bicycle, you've got all the components made by manufacturers. Then they're assembled, usually by a major brand like Trek or Specialized or something like that. And then they go through a retail outlet, like your local bike store. And so all those mouths have to be fed along the way, and that creates the final price. Well, what this company did is they basically were, with a few phone calls, they were able to organize their own direct purchase from the various manufacturers, and then they assembled the bikes in Utah per custom order and shipped them online. And they had a guarantee if you didn't like it. One of the great things of a bike store is you can actually ride a bike, and I've always been kind of hesitant to buy something as important to me as that online. But oddly, people are willing to do. They're willing to buy furniture and bicycles and all kinds of things sight unseen. So this company was able to deliver bicycles with the same components and roughly the same frame quality, maybe even better than the brand name bikes, for about half the price. Same group set, and so the liquidity tidal wave, as more things become liquid, then the concentration of liquidity at the top will gradually be nibbled at. And I think it's too early to say that it's going to cause Wall Street stocks to fail. I think that's not a foregone conclusion. But certainly it does mean that there'll be many more opportunities for companies to raise capital and for those investors to exit those positions much earlier without the company necessarily having to go to either an IPO or a merger. And now, why do I care about this at all? Because my whole focus is impact and vegan ethical investing, and the growth of economies that recognize the value of ecology and the intrinsic value of animals. So in that economy, right now, there's about 2,000 vegan companies seeking capital. Only about 1 in 200 are actually succeeding. So we have, if we think of all the important values that vegan entrepreneurs are bringing into the world and how much that's going to affect our quality of life going forward, climate change is, in my personal opinion, is primarily an issue related to eating animals. And in large part, technology as well, but really not just eating animals, it's not valuing animals properly as living beings. And that's a lot to say, because in our culture we don't necessarily even value humans as living beings. That's another revolution, actually affirming life on the planet, especially as an American, so much of our taxes go to just killing living things. But that's not my value set, and there are a lot of people that agree with me, and we value letting things live, letting trees, leaving them alone, leaving forests alone, leaving the oceans alone, letting animals live their lives. So now, as the liquidity moves farther and farther up the development chain, this gives us so many opportunities to develop companies, lower the risk of that, and also develop companies that might not have been really fitting in the normal, or what we think of as normal, customary distribution chain. So what's really happening is a massive disruption in in what we've taken to be the normal distribution chain of investment products, of securities. So these are some important trends. Vegan Launch, I feel, is I'm happy to be in the middle of a trend, because I haven't been, most of my life, been a little too far ahead of the curve on the things that I care about, like nature, like protecting the environment. Kind of a weird idea, don't you think, to actually make sure that there's air and water, air to breathe and water to drink. It's weird. I'm a weird person that way. I like air and water and trees. So there's even liquidity in saving forests now, because the mega trends of carbon is just going to be increasingly valued because the losses to climate change, there's so many assets that are already being lost, ski resorts, so, snowpack, beachfront homes. So a lot of the high value real estate and then, just millions of people's lives, food supply. So the real cost of ignoring climate change is gradually, bit by bit, especially in the EU, getting more and more factored into the economy. And as a result, if you want, in certain parts of the world now, you can buy forest land, and if you just hold it, you can generate revenue just from that, because the intrinsic value of a standing forest is finally, we're seeing the dawn of the accurate value of nature, which is really, it's priceless. But if we put enough price on it so that people will shift their behavior, that's enough. And same with animals. If we really understand that all the species on the planet, they're like the canary in the coal mine, and humanity's been eating the canaries. That's a bad idea. And gradually, and really not so gradually, it's the mega trend. So climate change waking up as a mega trend, waking up to the value of animal rights, to human culture. This waking up is now being monetized in terms of the valuation of vegan companies. And vegan companies, and we'll call it, I'm more interested, there's plenty of people working on techno fixes to problems that I believe are largely ecological. So my interest is much more on opportunities to create cash flow that is harmonious with ecology and animal rights than any one technology. And we're just seeing more and more of these opportunities. It's so awesome. The work I do with the new Vegan Launch platform, even the very work that I've been doing with entrepreneurs will become much more distributed. People will soon be able to get the same thrill I do when I see the very first edition of when entrepreneurs come to our website, they fill in an opportunity form, an intake form. And when I read their first words about their company, it's just so inspiring, and I'm so eager to share that with everybody. So I think I'll close it up. If you want to get involved in the liquidity tsunami in the vegan sector, come on over to veganlaunch.com and sign up as a member. It's free. And over the course of this year, you'll get more and more training, more and more access to these great vegan founders who may never get capitalized if it's not with your help. And you'll see when you see these that there's so many companies worth financing, and there will be alpha. Obviously I can't guarantee that on any of them, but you'll see for yourself. You'll learn how to understand where the value is. I can't sit here and say, well, this company's going to make you money. That's not, first of all, nobody can say that, even on Wall Street. That would be called a forward-looking statement. The risk is still high. In fact, the risk on Wall Street is high. It's always in the fine print. In any investment, you can lose all of your assets. That's no different than the vegan sector or the ecology sector. But these things are worth trying. They're worth committing to. And I think that I want to share that commitment. That's really what Vegan Launch is about, is allowing more people to use their money to commit to the kind of world and the economy that people like us want to see. And now we've got a lovely, growing community. And combined with fintech infrastructure, e-learning infrastructure. So we're really at the dawn of a community that I believe can really make the world a better place, and both design and finance the world we want to live in. So, as always, thanks for listening, and I'll see you in the next video.